Hello, I'm Hagen Rogers with Watermark Advisors, and today we want to talk about an issue that is prevalent in M&A, and it relates to cultural integration, cultural due diligence. We know that humans are flawed, and that plays out in the business world as well, as we see the same mistakes being made over and over. And so today we want to share a story, a very interesting one at that, about mistakes made in cultural due diligence and integration. And the story is with Amazon and Whole Foods. In 2017, Amazon bought Whole Foods for a $42 per share stock price. It was an all-cash offer and a 27% premium over their current trading stock price at the time of $33 a share. Wall Street loved this deal. They expected the synergies would be huge. In fact, so much so that the market, the week of the announcement, both market caps combined of the two companies went up $14.3 billion. Amazon saw huge wins with this acquisition. They were going to gain 30 million affluent shoppers, 463 grocery store locations across the United States, and a wealth of data. In addition to that, they would be able to sell their own groceries now in physical locations while implementing their own technological expertise to modernize and reduce operating costs at Whole Foods. But soon, like many deals, this marriage made in heaven started to have problems and cracks. So let's unpack this story a little further. First of all, during the deal phase, this deal moved, the structuring of the deal went very quickly. Amazon required, as most buyers do, confidentiality, and so in the rush, we can't know for sure how thorough the due diligence was in cultural due diligence, but clearly there were lacking takeaways that were evident if they had looked closely. At the same time, Whole Foods was trying to avoid being sold to an activist hedge fund. They did not want that to happen, so they were steering their ship towards Amazon. And like so many deals, cultural due diligence kind of falls to the wayside. And what a shame, because these companies had two very different cultures. Amazon was a powerhouse in logistics, prioritizing speed, low costs, efficiency. They use data to optimize everything and enforce strict discipline to squeeze out cost savings. And Whole Foods built its brand on high touch, employee empowering culture, emphasizing high quality and local foods, a philosophy that led to inefficiencies and higher prices. And problems began to show up post-close, soon after the close, in fact. Whole Foods employees became dismayed. They lost local decision-making authority to the processes and rigid procedures that Amazon implemented in their culture. And they even began to talk about unionizing their employee base. And for the first time in 2 decades, Whole Foods dropped out from Fortune's 100 best companies to work for lists. And then we had an introduction at Whole Foods of Amazon's inventory management system, an order-to-shelf, very strict process that Whole Foods was not used to, which resulted in empty shelves and poorly stocked stores. Employees became more bogged down in excessive paperwork rather than doing what they did best, which was serving their customers so well. So this resulted in so many nightmares, so much so that it was reported at one point that many times over, many locations, you could see employees crying out on the floor and even having nightmares about this new inventory tracking scorecard and pop quizzes. So Edgar Sheehan, a very well-respected organizational behaviorist, once said, "Culture may be loosely thought about, but it is only after the merger that it is taken seriously," suggesting that most leaders make the assumption that they can fix cultural problems after the fact. I would argue that leaders must make cultural analysis as central to the initial M&A decision as the financial product or market analysis. So when you're making, as a buyer, the decision how to integrate two different cultures, you need to first have done a great job at due diligence in HR and culture. And when you're then applying that research and analysis, there are really three different levers you pull as the buyer. First, autonomy. This is the most emotional decision. This is, do we continue to empower the leadership and employees at the target company, or do we strip some of that authority away and bring that centralized to the acquirer? In the case of Amazon, they did strip away some of the authority of the store managers and employees to the detriment of the value of Whole Foods. Interdependence is, to what degree do you overlap supply chains between buyer and seller? And in the case of Amazon, Whole Foods had so many live organic products that Amazon didn't sell. This was low interdependence between the two. And finally, controls. Does buyer put in place their processes and procedures, financial controls into seller? That's exactly what Whole Foods did, to the detriment of with inventory management, which really created a lot of chaos and havoc at Whole Foods. So the takeaway here is that cultural due diligence cannot be a passing thought as you're structuring the deal and focusing so much on legal, financial issues, negotiations of all different issues. The due diligence process itself, and specifically culture, has got to be prioritized. And then the takeaways from that have to impact the final decisions made in how you transact the business to acquire it, and then over into integration. How you integrate target into buyer has to be directed from a great job at cultural due diligence. So we at Watermark know that to do M&A well, buy side or sell side, but here we're talking buy side, it's so much more. We have to bring so much more to the table than just being experts in deal transacting. It is bringing a collaborative group of experts along with us on behalf of our client in due diligence and integration that brings to the best results, which is ROI capture once you step off this metaphorical M&A bridge. I hope this has been a fascinating story to hear about, and we'll have more to share in the upcoming weeks. Thank you.